All right, we're back with the Mechanics of Money, and this time with a friend, Vuk, and really excited on our end to go talk to him today too. I think he has a really unique background, both from the academic side, from the trading side of the house too, right? Where most folks we have in the show are focused in the traditional private markets, right? They're focused in real
Mhm.
estate, they're focused in private equity. So really excited to have you on today.
Thank you so much for inviting me, Sam. Happy to be here.
Yeah, so why don't you give us some of your background too? I know it's definitely not the traditional fund manager background we hear.
No, not at all. Not quite the opposite, right? So my background was academic, right? So I was academic, become an entrepreneur, founder, and then eventually a fund manager. So it's downhill basically in terms of life choices. I'm kidding, uh, but yeah. So I'm from Croatia, by the way. I live in New York for the past over a year now. But I'm from Croatia originally, and I did my studies, my PhD at Oxford. And during those studies, with two of my friends, one is a computer scientist, one is a physicist, I did my PhD in political econ. So with the two of them, we kind of developed this methodology to help us predict elections. That was our kind of initial idea of what we wanted to do. So we wanted to do like a Nate Silver thing, only better, because we wanted to use a combination of wisdom of crowds and network analysis to give us a better idea of how to kind of figure out echo chambers, right? And move past that and try to basically get the signal from the noise, to kind of borrow that term, in order to make better predictions of elections, right? So we were saying our logic was polling has gone bad, gone sour, especially back in the early parts of 2010s. And so we did this as like a grand opening on Brexit and on Trump in 2016, and we got really, really accurate results. So Brexit was accurate within a single percentage point margin of error. Then we did the Trump Clinton election for all the key swing states, got them all correct. We only did the swing states, like the 10, 15 swing states. And once we got those results really well, we decided, our initial idea was academic project, write a paper, publish it in like Nature, Science, or somewhere. But then we said, you know what, this works really well. We should monetize it instead. And so we started a company, mostly did market research and elections for a couple of years. And then in 21, so we did a Biden election as well, also captured it really accurately across all the swing states. And then in 21, we said, let's see if this works in the market. So same logic. I'll kind of walk you through that, but let me just finish this part. So same logic. I took $20,000 of my own money and brought it up to over 50,000 in a year and a half. And then we did this very openly in the newsletter. I was posting like screenshots of our giving out a signal of what we were going to trade. This is how we developed kind of credibility, and eventually started trading other people's money. We started very small, $700,000 AUM, which in this industry is nothing, but we scaled it up to 70 million in 2.5 years, and now, like, almost 3.5 years later, we're still in business and we're doing well.
So what's your take on, like, the second you hear the election and kind of prediction markets, right? I feel like you see a new prediction market thing pop up every day, right? Between
Yeah.
Kalshi and Polymarket and all these things. Like, what's your take on those markets themselves and how people trade in them, right? Because I think of, you know, say like sports betting, for example, right?
Mm-hmm.
There's the vig is set, right? The lines are set, but I feel like you can actually have more edge in a space like a Polymarket or in a Kalshi or something like that too. So, kind of, what's your take on what those have done for the industry?
Yeah, so absolutely. I think, like, they've definitely revolutionized the industry. I love the fact that they exist. We've been following them for a while now, and there was even a point when we were negotiating with one of them whether we should trade on their platform. Unfortunately, so for us, it's so we can't, for example, use the signal to trade the contracts on. So what we do is we predict S&P, for example, at the end of the week, right? And so if we're directionally right, we will buy options on that on those positions. Now, for us, when you buy an option, when you're buying spending premium, the amount you can lose is the premium that you paid for, and it gives you an exponentiality, right? So it gives you this convex payoff, right? So let's say we're risking 2%. If we're wrong, we lose the 2%. But if we're right, if it really moves, the market really move in favor of our direction, so either up or down, then we would make 4, 5, 6%. So you have an exponential curve. Whereas with prediction markets, it's your upside is limited, right? That's the problem of why we're not trading it. Because you're either, if you're right or wrong, it's the binary outcome. If you're right, you get something like you're buying something at what 70 cents, you can make 30 cents a profit, right, on the dollar. For us, it's kind of the opposite, right? So if we're risking 30 cents to make 70, rather than risking 70 to make 30. That's why, even though I think it's a great business opportunity and a great idea overall.
So walk us through what actually goes into it to go make these selections, right? Have these points of view. Kind of walk us through what it is that you built, where you can actually get better insights than the average person looking at it.
Yeah. So our logic is it stems from the idea of utilizing wisdom of crowds. That's the first approach. So the wisdom of crowds is, so I ask you, so what do you think? Let's use elections, right? So who do you think is going to win, right? Trump or Hillary, Trump or Biden, whatever. And then you have a certain opinion, right, of who's going to win. And then the second question is, what do you think other people around you, so in your state, think is going to win? Now, you always, obviously, especially if you're like a political junkie, you have a good idea of the people in your state. For example, you might be from a swing state, and then your opinion is more valued. Whereas, for example, if you live in New York or California or, I don't know, Idaho or Montana, you're pretty much certain of the outcome. Like every time it's going to be a red or blue state. So that's why your opinion matters most in the swing states, right? Where you're kind of telling us what everyone around you feels, right? So if let's say you're a Democrat voter, but you know that everyone around in your swing state is voting Republican, then this gives you a much better, let's say, insight, right? So if I just ask you who you're voting for, you can say Democrat or whatever, right? But then it's about getting the opinion of everyone else in your state. That's kind of the logic. Now, this second question, the introduction of this second question of what you think others would do, this is the direct application of the Kahneman-Tversky logic, right? The psychologists, the behavioral psychologists, right? Because you're forcing people to take a step back and to spend 45, 60 seconds more on a question to put themselves in other people's shoes. So it's like the neighbor method. I don't know if you were following, like, this latest election, the Trump-Harris election, there was a trader in France who used the same on Polymarket, right? He was using the neighbor method to try to figure out who would win the election. So that's just the first part of our approach, right? It's sort of like wisdom of crowds, neighbor method. The second part, then,
before you dive deeper there too, like,
sure,
how do you think about that too? So for example, right, if you look at, say, Florida, right? Florida's very red, but big cities in Florida are very, very blue. So how do you break it out in terms of, capturing the overall point of view from everyone based on where they are in that given area? Because you may have 10, 20, 30, 40 different pockets to go cover in like one given state.
Yeah, exactly. So that's what, when we used to do elections, we would make sure that there's enough representation across the state, right? So I want to see the cities, and I want to see the rest of the country, but it's also the question of, so if I ask you, you live in Miami, I assume, right? In Florida. So you live in Miami, and you know that Miami is predominantly, most of your friends around you are going to be blue, right? But you know that the state is turning red. You just told me, right? So I ask you who's going to win the election, and regardless of like what your immediate group thinks, you know that the whole state is going to probably be red, or there's a probability that you assign to it, right? That's the logic. So it's and that's where the second point is really important as well, because the second point of the approach is, so that first question, in essence, wouldn't be enough for our approach, right? What we need is the second part, which is the network analysis. So we do all of these surveys. We do them for social media. We used to do it on Facebook back in 2015, 16. But now it's mostly Twitter, X, and LinkedIn, but X predominantly. And so we basically, you come in, you give us, we don't see the names or anything. We just see the network, so who you're hanging out with, so that we can see if your group is also converging in your opinion with you, right? So for example, you come in and all your friends from Twitter are in there, and I can see that you're all connected and you're all blue, right? Or you're all red, whatever, right? And so this gives you a certain probability weighting in our distributions, right? So if you're only surrounded by like-minded people, you're more likely to be biased or in a cognitive bubble, echo chamber, and therefore your weight in the distribution goes down. So that was like with elections. The same logic is with markets, right? So if you're surrounded by perma bears, for example, then every week you're going to think the market is going to sell off. You're going to be right once, eventually, right? But then most of the time you're going to be wrong. And also vice versa. If you're just perma bull every week, fine, you're going to be right most of the time, but sometimes you're going to be wrong. But we're trying to find people who are kind of in between these clusters. Obviously, there's a lot of echo chambers out there. I belong in an echo chamber, obviously, like all my friends think in one same direction, right? But the thing is, right, I want to find people that are in between. So in politics, this is, let's say your group of friends is, some of them are Republicans, some of them are Democrats, some of them are centrist. This gives you a higher probability of being right. Doesn't necessarily mean you're right, but it gives you a higher probability. Same thing with markets, right? So you want to see people in between clusters rather than within them.
Really interesting. So how do you actually go out and extract all that data from them?
Yeah, so it's a survey, right? So you volunteer to give us the data. We reward people with money. Like before, when we were just academics and we didn't have an infrastructure, then we would just be, giving out bragging rights. So be better than your friends, compare yourself to your friends. But now we actually can pay people. So we give $8,000 quarterly prizes, and then we give 3% of what we make as the fund, as our management company makes every year, distributed across the winners. So that's a way to keep people kind of engaged, encouraged to participate. But yeah, so for us, it's about, like, when we did elections, it was about finding people that are on both sides of the political aisle, especially those in between. With markets, it's similar. But it's looking at, again, day traders, retail day traders, or swing traders, or whatever. So people that are following the market. So I did have a lot of my friends come in, but they would not stick for a long time in the survey just because they're not following markets, right? So so we need someone who is actually trading and participating to give us this opinion. And the point is, you want diversification, right? You want decentralization. You don't want people biasing you in one way or another. So, for example, if you go to an institutional account, everyone there might be more biased than a group of very much distributed and heterogeneous individuals, right? Retail individuals. So even though, not a single one of them is going to be accurate over time, right? So over time, and we're doing this for 4 years now. Over time, you can see that most people are 50-50, right? But then you have pockets of time when some people are better than others, and this is what we're trying to capture.
So walk us through the actual trading platform itself, right? Again, I know a lot of listeners here are more so private markets, or they're people who are investing into ETFs, right? Or maybe they trade themselves through one-off. But walk us through what the actual platform looks like, what you invest into each week, right? Like how you structure all your trades.
Sure. So the platform we're talking about, the platform is just our survey app. So it's a competition that I mentioned, that we give out rewards. And this is something where we have 3,500 people participating and giving us these signals, giving out their opinions, essentially. And from these opinions, we extract the signal, and then we trade. We trade it regularly for our broker. So we're a fund, we're a registered fund in the United States, and we trade it for our broker. But the way that we do it is we buy options. That's our trade. So what I mentioned before, 2% of our NAV, of our portfolio, our total portfolio size, is used every week to buy premium, to buy either calls or puts. Right. So if we think the market is going, the signal says market is going up, we would buy calls that expire at the end of the week. So it's a very short term, it's a weekly trading. And if we think the market is going down, then we would, if the signal says the market is going down, we would buy puts. And we only risk the 2%, meaning that, your losses are basically limited, right? So yes, theoretically, you can, 10 weeks in a row, you can be wrong, and then you're losing 20%, right? But you can never lose the entire portfolio all at once. That's the whole idea, right? Because we're always buying options, we're never selling. So for us, volatility is good. When option prices are cheap and then they jump up on a piece of news or something like the start of the war in Iran or the end of the war in Iran, right? Both of those events are potentially good for us because you have, option prices going up, either calls or puts, depending on the event. And this is where we try to make most of our money. But the whole idea is, when you're trading options, most of the time you're not going to make a lot, right? You're going to make something, either lose something small or make something small, right? So our losses are always protected by the amount of premium that we spend. So the aforementioned 2% of the portfolio. But the upside is high. However, it doesn't happen that often, right? It happens 5 or 6 times a year. You get to capture that big upside, right? Most of the time, like, we're going to be right more often than not. Our edge is about 60-40. So we're going to win more weeks than we lose. But most of the winning weeks are going to be like 0.5, 1%, something like that. Most of the losing weeks are also going to be like that, so 0.5 to 1%. But then a couple of weeks a year, you're going to make 4, 5, 6, 7%. And those weeks really make your whole returns.
So basically, you're making 52 trades a year across the board, right?
Yeah.
1 trade per week. So if you're 60-40, you're getting, 10 weeks of spread in terms of, net stuff. Yeah.
Exactly. But it all comes down to about 5 times a year when you're making, like, really, we had during tariffs last year, for example, we made 6% the whole month. Right, so this is an example of a trade that goes in your favor, and then you capitalize it. Or when there was this in December 24, Powell's very hawkish press conference. Markets went down 3%. We were buying puts. We made 7% that week. So these are examples. Again, they don't happen often, but they do happen often enough for us to exploit them and make money.
So how have you kind of fared, right, relative to the S&P 500, right? So for listeners here who are considering, getting out of private markets or kind of putting more money into public markets and diversifying, say they, because the thing that we deal with on our end too, right, is everyone looks to you, how are you performing versus the S&P, right? Can I go put it into this, and put it into an index fund, put it into an ETF, and just be totally hands off, not think about it, and kind of looking at performance relative to that. So on your end, like, how do you compare volatility to it? How do you compare performance overall to it as well?
Yeah, so I mean, I can show you our charts basically, but we are outperforming since inception, right? So since February 23, this is when we started, we're up gross about over 100%. So net, it's going to be lower. That is going to be around 70%. So after fees, which is just a little slightly over S&P in net terms. In gross terms, it's obviously bigger, but you should always compare net because that's eventually what the investor gets, especially if you're just investing in an ETF where the fees are very, very low. So yeah, something around that, but with much lower volatility, obviously. So especially during period, and most importantly for us, zero correlation. Our correlation is minus 0.055. So, and this is especially, you can see this because during the periods of the biggest decline, like March this year or April last year, so the Iran war or tariffs, or whenever you have some disturbance in the market, this is when we tend to make the most money, right? During the drawdowns. Or in the market drawdowns.
Got it. So your positioning isn't so much outperform market in the good time; it's more so outperform market in the bad time, right? In terms of how
exactly outperform the bad time and keep it steady during the good times. And so we can obviously we're making money right now after April as well. April, May, we're actually even better than March. But the structure is you kind of have this basic exposure to the market, which is a beta, and then you have the alpha on top of it, which is the option strategy. So that's the logic. So the way that our product is built is really to kind of help investors who want to have this exposure in the market and not be worried when things go sour, right? Because this is when we step in and we make sure the differential is there.
And let's pivot a bit too. So I know on your end, right? You were an academic background, PhD, and now going into trading for yourself and now working with investors, right? You've scaled up to 70 million, right? Growing from there, I assume, to
it's a little bit less now. It's about 58.
Okay. So like what's been the biggest swing for you in terms of like that learning curve to go out and actually raise money? Because I think what people miss sometimes too is that they're two separate businesses, right? The actual function of delivering on the thesis, and then the ability to go out and kind of run in capital markets side of the house too. So on your end, like, what's that relationship been like for you?
Yeah, it's 100%. You're right. I mean, it is it's a grind, like every job, every business, right? Especially when you're running. So I'm the co-founder and the owner of the business, right? So it's in my best interest to not only have great performance in the fund, but also make sure that we have as much AUM as possible. Because again, we can have great performance, but if you have the bigger the AUM, the more money is left for us as the owner.
Traditional 2 and 20.
Sorry. No, we have 1.5 25, but we have an 8% hurdle. So we have to clear the hurdle, which is kind of the average returns of the market, like over the past 60, 70 years. So if you and only above the hurdle do we apply the 25%, right? So the first 8% belongs to the investor. Everything else we share 75, 25. So that's the fee structure. And again, so we're doing this because we're a growth fund. So we tend to make, so our annualized, about 28, 30% gross. What was I going to say? You asked me a good question.
I was saying kind of more so like the relationship between, you go from...
Right, yeah. So it's obvious, again, like getting performance good and in line is hard enough, right? So we do have a quant team now of 5 people, and we do have algo developers that are developing our algorithmic trading system, so that makes the whole thing like fully systematic quant options trading fund. So that's essentially the product. And so I was trading the whole thing myself for about 3 years, right? And now I'm finally kind of divested from that, so I have more time to talk to people and engage. But yeah, I mean, fundraising is, the hardest part, obviously. On the other hand, good performance makes fundraising a bit easier, obviously. Whenever you have a period of drawdowns or like a couple of months where you're not making any money, then all the allocators are like, oh, let's see, if this persists. Again, it comes from being young, right? From being new in the game. So there's several things, right? Okay, so you're a new manager, emerging manager, you have to prove yourself first and foremost. And then, what allocators often like to see is when you do have a period of drawdowns that lasts a couple of months, when you're not making money or you're losing or whatever, then they like to see how you bounce back from that. Because, often you get investors leaving or not being happy with performance, and you have to deal with that. But again, it's all part of the process, right? So I've learned a very long time ago that in trading, losses are just part of the game. And it's the same thing with running a fund, right? So I was trading before on my own. So I didn't have like zero experience in this. But I was trading as a retail trader, right? So basically, no particular edge, just my own emotional issues and the baggage that comes with it that prevents you from being good at this job. But then you kind of learn. You lose money and you learn, obviously. The more you lose, the quicker you learn, hopefully. And then, but yeah, so the most important thing is basically the process. But again, reconciling those two things is obviously difficult, right? You have to put a lot of energy into fundraising, and then these things typically take a while. I would love to have $1 billion fund right now, but it's not going to happen overnight, right? It's a long process to get there, and there's a lot of people that are on my list that like us, that are following us. They're not allocating because it's just a process. It takes time. But again, keep in mind that like finance is a trusted industry, right? It's a trust business, a personal relationship and trust business. When you develop trust in someone, they give you money. That's as simple as that. And developing trust takes time. I'm new in the city, just living here for a year, so it's going to be a while for me to develop trust here.
And so in your structure too, I think it's also something that's harder on your end too, right? And a lot of deals that we do, for example, we've got, minimum 1, mostly 2 or 5 year lockup periods, right? In our end too. What lockup period do you guys have on your capital that comes in?
That's one of the attractions. We zero, right? So you have like 2 weeks notice period. So we don't have a lockup. We have monthly access to liquidities with a 2-week notice. And that's one of the attractions, again, us being new and trying to establish ourselves in the industry. So that was one of the packages that we were offering, right? So no lockups, which is very attractive for an allocator. But again, it still takes time to develop the relationship. You can offer as many bundles as you want and many good pricing models as you want, but eventually in this business, it really comes down to trust.
Yeah, it's interesting too. That's just a whole different type of pressure too. Like you're month to month in terms of performance too, kind of looking at the outcome there.
Yeah, it is. So, sorry, what did you say?
I was saying, like, yeah, like you're month to month in terms of like how people are vetting you and viewing you too. Like you have a very, very short window of time to go keep managing their money.
Yeah. Yes, absolutely. Right. Exactly. So it's every month is every week for us is a new game, right? Every week, because it's uncorrelated, right? Every week whatever we buy during the week, we sell at the end of the week, right? Every Friday we're out of positions, right? And then we start again. So it's a cash allocation for the next week. So that's the thing, right? Every week is uncorrelated to each other. Every week for us is like a new game. Like think of it in sports, right? Every week you have to prove yourself over and over. You can have a lot of big victories. In the end, are you going to win the title? Well, it depends.
Cool. So I want to switch gears a little bit too. So I know you came over from Croatia to New York. Yeah. Could you walk us through some of the differences, like culturally, around how people operate in business, how people view money? Like, how is it different in a place like Croatia versus being in the financial center of New York?
That's a great question. I can give you like a more broader, not just Croatia, but European Union, EU in general. Right? Croatia is an EU country. So like the main thing that I noticed is incentives, right? Like completely different incentives to work here and there. So in Europe, that's the thing is like after you reach a certain, let's say upper middle class living standard, which can be, let's say 5,000-6,000 a month in places like where I come from, like Zagreb, you live really, really well. Or, even in places like, I don't know, Lisbon, or Greece, or south of Italy, for example. Like that's like, with that type of money per month, you live really well. Whereas in New York, 5,000 a month is 60,000 a year. So you're basically, below, around the poverty line. So it's not really a good life. But the thing is, like, so after you get to that stage, you can So I mean, I have a wife and 3 kids, right? So with a family, you can have, live in a nice apartment, nice neighborhood, 2 cars, summer house, summer vacation somewhere, winter skiing and whatever. You're not going to the top place. You're not really rich, but you feel relatively wealthy, right? Whereas in the US, you kind of, so there's no incentive. My point is, above that certain level, yes, you can make more money. You can buy a bigger car, better car. You can buy a bigger house. You obviously live a better life, but the quality of life is not that different, right? It's not that big of a difference, right? Whereas in America, in here, what I noticed, especially in New York, there's an exponential curve there, right? So the more money you make, obviously your life, you can really see the improvement on your lifestyle, right? If you go from 60K to 120 or 120 to 250 a year, your life improves considerably in terms of where you live, in terms of the opportunities you get, in terms of like schooling for your kids, healthcare, a bunch of different things, right? The car you drive, the life you live, the lifestyle that you live. And so there's an incentive, and that incentive is embedded, right? And so it pushes you to, okay, so you make $1 million, then you make, for example, with a company, you scale to 10 million, then you scale to 100, and you scale, because the system pushes you through to do that. Whereas in Europe, it doesn't, right? You get to a certain level of a lifestyle, and you're pretty much satisfied with it, and you don't have to push anymore. So that's the especially like from a perspective of an entrepreneur, because I was an entrepreneur in Europe and I'm an entrepreneur here, and you can see these differences clearly. The tax system and everything, it's pretty much similar, especially for like individuals. But again, the tax system here is much more favorable for businesses. Obviously, if you like own a business, you're much more likely to kind of get wealthy better than being an employee. I mean, obviously, you can kind of advance within a corporation, become the CEO or whatever, but as a business, you're much more encouraged to do that. Like someone once told me, America was like made for businesses, not for people, which I can clearly see. And so these are kind of the main differences that I noticed. Also, and that's also why you're going to see so many, much bigger valuations of American companies, much more billionaires here than in Europe. In Europe, billionaires are mostly old money, right? Whose families were rich 300 years ago, like 200 years ago. In America, you see this like new generation keeps building new stuff, really cool things. A lot of people sell their companies to bigger industry giants. That's how they get rich. Some others build their own empires, and that's very cool. And you're very much. I feel that you're very much encouraged to do that. Also, I think that it's and it's the final thing I want to say. It's much more easily scalable. Scaling in America is much easier than in Europe, right? So let's say I'm from Croatia. If I build a cool product, I'm not going to be able to sell it in France or Germany just like that, right? Whereas here, if I'm from, I don't know, Ohio or somewhere, I can build something that works there. I can scale it. I can sell it in Florida. I can sell it in California. I can sell it in Texas. It doesn't really matter, right? It's kind of state level integration or scaling is much easier. At least that's what I've noticed.
No, I mean you're spot on too. Do you think that people in Europe, because of kind of I'd say like capped ceiling in a way, right? If you look at what they can go achieve, do you think people are generally happier there too?
Yes, definitely. Yeah, I can say that in terms of the quality of life, it's higher. But it's a question of what you want and what how the system is designed, right? So if the system is designed that you're not really encouraged to kind of make more money, then you're happy with what you have because you can already live a very comfortable life. And that's pretty much it, right? But in America, you're kind of encouraged to want more, and obviously, yes, that triggers different levels of happiness. Again, so we're talking averages, right? Obviously, you have differences, right? You have some people that are happy with whatever they got. But we're talking about averages. People always, whenever you mention averages, but there's an exception. I know this guy who lives really, of course, there's an exception. That's why we're talking averages, right? Just to make that point.
Yeah, it's interesting too. Like I feel like America, it's just if you look at, hey, I'm gonna go build a business and go scale and go really big, like there's, at least in my opinion, like no better place to go be in terms of opportunity. But if you look at certain things around quality of life, right, where I think if you look at Americans, like they, live to go work, where other countries they work to go actually live and have a functional life. Yeah.
No, absolutely. And again, I think the reason for that is because of how incentives are aligned, right? So I also noticed so I'll give you another example. Like in the EU, so in here, if you're an entrepreneur, you want to found, you want to start a business, right? You're gonna learn how to sell the hard way, right? Because if you're not selling, you're not growing, you're not eating, right? You need to learn how to sell in the market. Your product, you're going to do a lot of trial and errors, right? You're going to do a lot of things before something finally works. And this is the story of every successful entrepreneur. Like a lot of us, I've tried many things that haven't worked and then find something that does work, right? It's normal. In Europe, I mean, obviously you do have companies that sell on the market and etc. But there's a large part of that economy. I mean, not in terms of like the size of GDP, but in terms of incentives, is with the grant-based system, right? You have the EU level grants and you have the government level grants, right? Where governments give you a grant to start a business, and they keep there's these subsidies. There's this inherent element where you can go to a government body and come up with a interesting proposal, and they give you money to start a business, which is, again, it works. It's great in a sense of it helped some businesses, some really cool businesses started off of government grants. But think about different incentives, right? So in here, I have to learn how to apply for a government grant for talking to a bureaucrat. Whereas in here, I need to learn, what works in the market, and I'm going to fail a lot of times. I'm going to go out there, I'm going to embarrass myself so many times until I finally find something that works. And then this is going to sell to a lot of people, and I'm finally going to be able to scale.
Yeah, really interesting too. Like I always think the cultural pieces are really interesting to go look at too, just in terms of how people operate based on where they're from, what their incentives and goals are too. So super helpful. Before we wrap here too, what advice do you have for someone who's looking at saying, I want to get into trading options today too?
Ooh, okay, don't. That's my advice. No, okay. I mean, okay. So trading options, it sounds very cool on paper. The first time I kind of learned about it was reading Taleb's book back in like 2012, 2013, Anti-Fragile. He was talking about options, so I started learning more and more as I could. And it sounds like a cool thing. Your risk is limited, but your upside is high. Yeah, but there's also the element of time decay. So your options decay very quickly if you're wrong, if it goes against you, and time decay can sometimes kill you even if you're right. So people don't really learn a lot about risk management. So if you want to kind of go into options, my advice, if you really want to go, if you're really stubborn enough to go, start very small and learn risk management based on that, because like you're going to have positions that are going to go against you just because, right? So it's not something that I would recommend lightly to people. But it is, once you get the hang of it, it works. But just like everything in life, be prepared to suck for a very long period of time before you get good at it.
There you go. Cool. Well, we'll leave it at that too. Thanks for coming on.
Sure. Thanks for inviting me.